we've now got a fantastic panel coming up for you, a real knockout panel. And we heard this morning Christina from Southeast Angels espousing the benefits of the UK Business Angel Association as a great area to look if you're looking for angels to attract to your business. And our chair, Jenny Tooth, is going to take you through some of the pitfalls and the joys of fundraising. And our panel earlier on with Emma, we were discussing whether angels and VCs can ever be happy bedfellows. We're about to find out.
So, as you see, we are angel and VCs here today, and we're very much there to kind of talk about some of the challenges and issues that we've already been hearing, and also from some great entrepreneurs, but also to give you a little bit more insight into really what investors are looking for, what the kind of current climate is for finding investment, and some thoughts you might give if you're looking to seek investment at the moment, and perhaps some of the thoughts about some of the ways you might want to position and prepare yourself. So, and we hope we'll give you plenty of time to also ask some questions. So absolutely lovely to have you all here today. And you will now hear from some absolutely amazing women, all of whom are part of the really, I think, very vibrant investment scene that we have here in the UK. So just kind of running along the line, I'm going to ask each of you if you would say a little bit more about your role, the funds you're actually part of, but what your focus is, and really just helping people understand a little bit about where you sit on that supply chain from startup through to scale up for those of you who are in different parts of that chain. So starting with you, Izzy, would you mind saying a little bit more about your role at Outsized Ventures?
Hi everyone. So I'm Izzy Fox and I'm the general partner at Outsized Ventures. We're an early stage VC fund, so we come in sort of pre-seed and seed, typically between sort of 500k and $1 million. Healthcare, tech bio, food alternatives and deep tech is our main focus. We do anything across the UK and also Europe. I also sit on the Innovate UK Council, which I sort of feel like I don't want to say after everyone's complained about the process, but I'll take the feedback back. And yeah, I think that, that's pretty much like where we've got cash, we're still investing. We've been really slow to deploy this year, but I think it's important to say that we do have money and we've still got 2 years of investing to do.
Thanks, that's great. Now, Hanadi.
I'm Hanadi Jabado. I'm the managing partner at Sana Capital. We are a tech bio fund based out of Cambridge, investing in the UK and across Europe. We probably follow on from where Izzy is. We do seed and Series A, but mostly seed. Really focused on tech bio and data-driven companies in health tech. I also am part of Innovate UK, sitting on the credit committee for the Innovate UK loans. And if you are looking at commercializing R&D and looking for money elsewhere than from vulture capitalists or angels, I highly recommend you look at it. The process may be long, but the terms are good, and the process is really good to shape you, to shape you up.
Thank you. And also, we'll talk a little bit more about tech bio, because everyone doesn't always know how that differs from biotech. So, Rebecca.
Oh, yeah, so I think I better start by declaring my Innovate UK credentials. I sit on the BMC interview panels at the final stage of reviewing, and Longwall is an investor partner. But I'm also going to disappoint everybody by not being a Series A investor. We're also proceed quite often the first institutional fund in, co-invest alongside angels very regularly. We invest, but Longwall's is slightly different in that we invest in all kinds of, it's very similar to Outsized actually, in that we invest in lots of tech, and where we do health tech and life sciences, it tends not to be therapeutic development, but more kind of deep tech, life science research tools, medical technology, that sort of thing. I've been investing in startup companies for about 15 years and following the stories for about 20, and this is the third investment firm that I've worked at. We're we've been investing, we're between funds at the moment. I should declare that up front. So when we talk about what I might be investing in next year, it's follow-ons into the existing portfolio, and we're out fundraising at the moment. So we can talk about that if
And
if
anyone
you want
who wants to invest in Longwall.
so that that's a whole other aspect of what we do that the companies don't always see. So
Thank you, Beck. And Tanya, lovely to have you here.
Hi. Oh,
Yes, are you on?
that's fine. Hi. So I'm Tanya, Investment Principal for Cancer Research Horizons. So we're the innovation arm of CI UK. So we help build and grow startups both from our own research base, from outside. So we have a seed fund that's oncology focused, invests everything from early stage validation pre-seed all the way through to early Series A. We can do follow-on into our portfolio companies beyond, but it's pretty rare. We don't have a focus outside of cancer, so it could be any exciting area, everything from therapeutics, diagnostics, devices, AI data solutions. We just really like to see something that has real potential to have impact for cancer patients. So that's our driver for our investment committee and our sort of investment philosophy. And that's probably about it at the moment. Oh, and I should say, I'm not sitting on an Innovate UK panel, but we are an Innovate UK investor partner, so there you go.
Which is also a very valuable thing to know about as well for those of you who got grants and that wonderful investment that comes alongside. And just say a little bit about my organisation. So I look after the trade body for angel and early stage investing across the UK. We look after about 18,000 angels across the UK, and also quite a number of those early kind of EIS, SEIS funds as well as part of our community. And the angels are really not all backing healthcare or biotech, but there's a very strong interest in the angel community generally in this area. And angels are bringing, for those of you who are less familiar with that part of the market, probably between about 100 and 2 million, which sort of slightly crosses over and co-invests with many other of these funds today. So just to situate that. First of all, what a wonderful lineup, and obviously a real variety of funds here for everyone to know about. But for many of you who perhaps have been looking at finding investment this last year, and for investors too, this has been quite a challenging time. We have seen across the market some, quite a lot of investing has pulled back, as you know, and you probably saw we had a really wonderful time in 2021 when valuations went up and it was very frothy for investing post-pandemic. But obviously we have had more challenges, obviously global and local. And I was really just going to ask all of you how far you have continued to maintain your investing approach over this past kind of 12 months or so, and how far some of the challenges out there in terms of both finding investors and co-investors and finding great deals, how far has this kind of affected your approach, and what has been some of the approaches you've used? And I did just wonder, for everyone's interest, because it has been a struggle for many entrepreneurs out here, has that made you have more a restrictive outlook on it, and different metrics, or much the same, business as usual? Starting with you, Tanya, because obviously you've got a very kind of solid and specific fund here.
Yeah, so it's been an interesting time, shall we say. So, we set up our fund probably just before, or got approval for the fund just before the downturn, and then launched the fund pretty much as the downturn was happening. So it's been an interesting time. We set up the fund so we don't have to have a co-investor, so we can sort of launch our own companies, even pre-company formation. And we've done that partly so that we can accelerate the science and not be tied a little bit to the sort of constraints of finding co-investors. I think what we've seen is changing is we've had a lot more demand for our seed fund than we expected from established companies that have had no previous link with us. And that's twofold. I think with the challenging climate, if a company is in the cancer space, co-investors are really or new investors are wanting to see investors who understand the space and understand the challenges that they're in. And so people see access to our seed fund because if we're buying into a company, we're buying into supporting them. So, ability to bring on our experts and access domain experts and potential collaborators, etc. On the other side of the coin, it does mean that then we are co-investing in rounds which are then subject to attracting other investors. So we're in the same situation as any other investor in that scenario. And whilst we can certainly help, it's taking a lot longer than, certainly a year ago would be to close a round. And things like Innovate UK, investor partnerships, the BMC awards are fantastic. And we're seeing a lot of companies who've been successful in those approaches but are still struggling to actually nail down the matched aligned funding requirements. So I think for us, the doors are open. It's a great opportunity because for us, actually, nothing changes. There's exciting science, there's exciting spin-out and start-up potential. If anything, we're seeing more substrate and deal flow. The challenge for us is then identifying the ones where we could have real impact through investing.
And just following that, I mean, what are your standout points for anyone who wanted to kind of approach you?
Standout points are really understand your clinical unmet need, the clinical target you're going after. Really understand the competitive landscape on your differentiated position. It's surprising how often people come to us and don't fully understand the landscape. And in reality, that's a reflection on the team because the team is the experts, the teams are the people we're backing. And I think the other thing is to be really flexible and agile because those business plans will probably end up changing quite considerably, taking on board investor feedback. And all of that investor feedback is given with the experience behind that says this is about trying to help you achieve a sort of investable proposition that will unlock the next round, which fundamentally is where our seed fund is. So we're not interested in investing, and our investment committee wouldn't approve anything that just moves the dial and then gets stuck in another sort of gap and won't unlock the next round. So for us, absolutely essential is an understanding of the next value inflection point and how your team and the budget is going to deliver that.
Thanks. Rebecca, how was last year for you and kind of what kind of things have you been looking at specifically?
So from the perspective, so as I say, we're fundraising at the moment. So I can tell you that is going to be slow for anybody who's fundraising at the moment. There's a lot of LPs, so the part of the investors that would invest in our funds. There's been all kinds of stories in the market, which I'm sure are true, but people have reduced their allocation to venture capital. They're a bit spooked. Just like any cycle, it will come back. But when the fundraising cycle slows, then everything slows, and it sort of starts with the allocation to investors. So it's I think that's the side that people don't always appreciate. They kind of go and see these investors and think they've just got a pot of money and they're going to write a check. There's we have to raise the money, and that's all part of a system, and we have to compete with other places that those investors could put that money on the basis of the potential returns. So there's going to be just less money in the system, and that's essentially what we're living through. But just like any cycle that we've been through plenty of cycles before, it will come back. And people always say this is a really good time to get started because if you can attract the investment to get going now, the smaller checks will be easier to raise, and then you'll be really well placed as the money comes back, and it will come back. Nobody quite knows how much it will come back because the pandemic stimulated a complete a boom in life sciences and healthcare specifically because of the feeling around the pandemic. There were lots of non-specialist investors that decided they wanted to invest in healthcare because clearly it was saving the planet and it was the future and all that sort of thing. And some of them have now figured out it's actually quite hard world to invest in, and they've gone away again, and that's part of what's happened. And also I've never been a VC investing in a world where we've got interest rates as competition, and so that's going to reset the goalposts in terms of nobody really knows yet how that's going to play out. But for the companies, so we've got a portfolio of companies that we're doing follow-on investments into, which is the structure of an LP, a 10-year closed fund model. We invest and then we expect to do subsequent rounds, and we follow those companies. And what we've seen, just like in previous cycles, is kind of the investors kind of say, "Oh, we've seen these cycles before, guys. You've got to rethink your business plans and rethink how your fundraising plans and all that sort of thing." And sometimes it takes teams a little while to hear that message and recalibrate and think about it. But what I think on the positive side, I've had several companies go through some really good rethinking to much more robust business plans that are less focused on kind of ambitious growth and big equity raises, and a bit more focused on minimum amounts needed to get to where they need to get to, and getting to sustainability as fast as possible. And that's sort of fashionable again, which has always been a preferred mode of action for us. So in some ways there's some positives that will come out of it. But that's been the picture of the last year, and people need to be very sort of strategic in how they think about fundraising over the next year. You need to find the fits with the funds, and if it looks like you may not be competitive enough to raise money, then think about why and what you can do, and think about if there's other ways to do it. But be kind of quite smart to what you're hearing from the market over the next year, I would say.
Thanks, Rebecca. And Hanadi, when you've been looking at last year and then kind of looking forward, how have you seen it in terms of entrepreneurs coming towards you and the kinds of investments that you've been making?
So I fully agree with what you were saying earlier, Tanya, in terms of the use of funds. Be very clear about the use of funds and what you want to do. And I'm going to get back to that in a second and echo what you're saying. It's absolutely incredible how painful fundraising is, even for us as VCs. And it's actually quite humbling. And I think we should all do it on a regular basis, because it makes us better human beings when the entrepreneurs come and pitch to us. So in terms of what we see, I think that what happened during the pandemic was a bubble, and there were crazy valuations, and stuff that shouldn't have gotten funded was funded. So people talk about FOMO. I have JOMO, and there were quite a few opportunities that I didn't join in, and I'm really happy I didn't, because it was unrealistic. So there is a rectification. That rectification was necessary. And there are companies that are raising at the moment, and they're raising at normal valuations that work for them as well as for their investors. And what I was warning companies 2 years ago is that they would be looking at a down round further down the line, and this is what's happening right now. So there's a rectification. Lots of companies, so I'm going to give you an example of two examples from a year ago. Two companies that started a round and were about to close just before Christmas. And both of them were let down by their lead investor. One of them had the legal documents signed, and the investor defaulted. And on the other one, they just got ghosted before they signed. The first one did something really brave. Woman founder, she went and raised at a down round, at a flat round from 3 years before. And she completely revisited the use of funds. So originally she was raising to enter the US market, and she had to reduce the amount she was raising, put on hold the US market, and penetrate the UK market better. It was really, what she did was really brave. And the company is now in a stronger position, and she's now looking at a Series A, but she's waiting for the market to come back. And she's in a position to come back because she's been really careful with the money she's raised. In the other example, the CEO realized he was not going to get his Series A, and he rolled up his sleeves and went and got contracts and managed to raise 3 million in procurement, and extended his runway and allows him to see a little bit more. So this is what I'm seeing at the moment, Jenny.
That's really interesting, because obviously you're seeing, obviously entrepreneurs being strategic, how they approach those challenges and those roadblocks, and then actually that resilience becomes really, really valuable through their longer term growth, doesn't it? So I think it has been, we always know in challenging times things actually can often improve for entrepreneurs, and I think it was an a bit of an unrealistic hike we had in 2021 that we are correcting. So it's good to hear those. And also for you, Izzy, obviously you see some great entrepreneurs as well. And how's last year been for you in terms of the entrepreneurs you backed or your own strategy towards that?
So we raised our fund just 2 years ago. So we got lucky with the timing. We were going to do a final close sort of this year, and the market was super hard. So we kind of just gave up with LPs and decided that we'd just stick with the number we got and invest it. We've been really slow this year. So we're meant to have done 9 deals. We've done 2. So we've been a lot slower. Partly that's just because the valuations were still moving downwards, and some of the stuff that we did like was still a bit frothy. So we've decided to wait, and actually now we're able to get in on those deals that we were liking in sort of January last year at the same price, but with less risk. So that was a good decision. We've just been cautious. I mean, we're really looking for what we call the 1% founder. And we are looking for exactly the same as, Tanya and everyone's saying on this panel today. It's really about keeping the cash flow tight, keeping the team tight, and how you can get to those inflection points for the next round, and knowing what that next round looks like. And if we can't get confidence in that, or the ability of the founder to be able to take the company with a big vision forward, we've just not been investing.
Yeah, I mean, so it's very, very important to understand the fundraiser's mentality, the fund's mentality, and understanding about that fund and how they invest and what they're looking for, I think, and especially at these times. And one of the things that I particularly wanted to kind of just talk a little bit about, because you see here before you 5 women, all part of the investment scene. And yet we know that for women, actually, as founders, these are challenging times. I mean, it was tough last year, and actually we saw, because we also collect a lot of data on the market as well, and we've all seen the amount of women who have achieved funding go down this last year. For many of you who may have followed the various data points, but the Investing in Women Code has showed that only 25% of women founders achieved investment versus 75% all male teams. And if you look at spin-outs, again, it's a similar sort of level. Only 25% of spin-outs have a woman founder in them, and only 7% of those are all female. And so, these are challenging times. But yet we know that there are fantastic women out there, particularly in this area of healthcare, digital tech, biotech. And I think that there are, from our perspective, probably not enough women also in investing. So I just wanted to get a perspective from you all about your approach to women founders, your own funding, and maybe any examples of women that you've backed that perhaps illustrate your support for women founders and how women might approach you. So thinking of you, Izzy, first of all, have you got any thoughts on that?
Yeah, I mean, we have female founders in our portfolio. I would like to think that we don't have biases, but I'm sure that we do. We are an investment committee of 3, so 2 guys and myself. And I think we try very hard to look at teams on their merits, but I'm sure that we still have issues that we need to face. And obviously, we all know that those issues are across many VC funds. So there's a lot of work still to be done.
What are your thoughts on this, Hanadi, as someone who's, part of both the angel and the VC scene?
So I think that there's lots of research that tells you that women get asked closed questions, whereas their male counterparts will be asked open questions. And I was on a panel at Slush last week with Inga, who's in the audience, and Inga said, as long as we don't have standardized questions like in an interview, of course it's not going to be the same questions that we're going to ask. And we just need to call on our own bias and make sure that when we're asking a question, whether it's a male or a female founder, we keep it as an open question. You know, a chance for them to show the growth rather than asking them to defend what they're doing. I was on a credit committee this morning, and I got annoyed every time that one of the credit analysts put forward that one of the strengths of that application is that there's a female founder. As in, you know, come on, can we just forget about the gender and just look at it on the strength of the application? So, you know, I'm pretty sure everybody around here is the same. We see about 1,000 deals a year. And we can invest, you said 9, you were going to do 9, you know, 8 to 10 a year. So how do you go from 1,000 to 8 to 10? And just making sure that we need to return an investment to our own investors. And we need to invest into the best transactions. In my experience, women founders are more down to earth. There's less VAT to be cut off. It's there's, sorry for the technical term, there's less BS. So it's actually easier to build an investment case around a female founder, because by the time they get to you, they've worked much harder. Joanna will tell you that I don't cuddle anyone, and I am not going to be kinder because it's a female founder, but I've got a portfolio that's 50-50.
Well done, and some very good points there.
It's super you've got a portfolio that's 50-50, because I put some, Jenny, we did an event together, didn't we, a couple of months ago, and I kind of, you know, got stats from, we're part of the Investing in Women Code for British Business Bank, because we're backed by the British Business Bank, and so we have to collect the stats and report them back, so I got them from the team and was really kind of disappointed by them, because they're entirely industry norm, and which really disappointed me. We're a 50-50 firm, as it happens, and I have to say, a landmark event for me, it's a landmark event that I'm on a panel that's all women. When I first started investing, people could only think of 2 or 3 female investors. So, you know, that's a fabulous development. But a real landmark will be when that's not noteworthy and we're not talking about it. So, you know, let's work for that day. But we do all have biases. There's no question about it. The research that some groups have done, particularly in California, where they've changed the names of people in case studies and then seen how the case studies are discussed, and it's absolutely, you know, the difference is because it's a personal business backing founders, we have personal reactions to behavior traits and to characteristics, and our role models and our pattern recognition is all based on this Californian mode of entrepreneurial drive, and, you know, women tend not to display as much of those sort of behaviours, and I think you're right. I think this market actually plays to the female strengths quite a lot, and I'm not a brain's a different thing, but I think there's an awful lot of socialisation very, very early on that brings out different behaviour traits in different genders, and we just, you know, the world will be a better place when we value both in different sectors. But you know, we try and call each other out when we're discussing companies and teams as a mixed group at Longwall. Someone once told me to look at people's wives to understand whether they're likely to be biased, and to ask whether they've got daughters. When you're, I think there's something in that. How do different people recognise different behaviours and different actions? And we should be honest about it. That there's work still to be done, but the world is changing incredibly quickly. I'm seeing far more deal flow from women. And when I did that analysis and I found our numbers were so disappointing, you know, we've sort of had 1 female-led company in Fund 2, I think something like 3 out of 15 or 16 in Fund 3. maybe not even that many, it's really disappointing. But it's actually more than the deal flow. So, you know, that's also part of the challenge.
And if I can jump in, I think, you know, I'm lucky because of the sector bias. I invest in health tech, and I've got some number from Burhurst. In 2022, we've seen a decline of male founder in pharma and medtech companies by 11% in terms of deals. Co-led founding teams have gone up 9%, and female founders 14%. So I am in a sector where you see more women, so my 50-50 is probably much easier than for you or for you. And I don't have quotas. I really try and go for the best business cases.
We have to, because that's what we do for our investors.
Yes, no, and actually that's very important too, is actually seeing more, we have more women in the sector. And as you know, what we're looking for is that, you know, is that supply chain, isn't it? That opportunity for more women to come forward. And for you, Tanya, obviously you're in a really important area of, you know, of investment and in terms of the sector. I mean, are you seeing some great women coming through, and any particular investments you've made that you want to speak about?
Yeah, I mean, we probably face similar challenges. I mean, our team is actually pretty much 50-50. We actually do unbiased recruitment, which is interesting, I have to say. I've gone from looking through piles of CVs to seeing blinded to age, sex, variety of different things you can blind for. But it does, you know, we've seen the benefits from it in terms of wider recruitment. But, you know, I guess we're not, you know, we don't have a quota, we don't have a requirement because we're led by the science. But we certainly have an emphasis on making sure that we're representing the entire of our community. And, you know, we run and support a lot of entrepreneurial programs. We try, for example, to go outside the Golden Triangle. At the moment, we're looking at how we encourage more sort of budding female entrepreneurs onto those programs, and whether we should run pre-accelerator programs almost to encourage women to apply. Because we do see that, you know, when I'm working with a female founder versus a male founder, 90% of the time, and I hate to say it, the male founder just, you know, pitches, this is fact, don't question me, I know what I'm talking about, which is great, confident, that's what you want to see. A female founder with an equivalent, if not a better proposition, will be, you know, very much taking on board feedback, but will maybe not be as confident about the voice, you know, behind it. So I think one of the things we're also learning about is having better examples. So we don't generally shout out about the sort of success stories in this country as a whole, and we shout out even less about the female entrepreneurs. And you know, we're trying, you know, to, you know, when we invite budding entrepreneurs to present at institutes, at centres, at panels and things, you know, how do we sort of get on board those success stories who can really, and also success stories of people who've moved in and out of academia and industry. So it's not like one person is going to have one career and that's their life for the next 50 years. People are going to move it in and out, in and out. So I think for us, there are more success stories, more exciting women who can sort of talk about their career journeys and entrepreneurial paths. We just need to put them in front of audiences.
And I think that's really important, the point you've made, though, case studies. We all learn so much from case studies, and that encourages, you know, many more women. The last, I'm still here, but I thought that was a great case study of an investment journey, and the perseverance of the women entrepreneur. If anyone saw that previous one of Booby Biome, which was great. You actually mentioned also about, you know, outside the Golden Triangle, and this is something obviously we do want to encourage. And I know Discovery Park may be based in Kent, but is looking to encourage investment in entrepreneurs from all over the UK. I just want to kind of just stop for a moment now and open up to the entrepreneurs or anyone in the audience who has any questions, because, you know, we've looked at some quite big topics, and the reason I've done that today is because often you can just get obsessed by saying, well, what do you invest in, what do you look for? This is really understanding the landscape as well around investing, because as an entrepreneur, you need to understand kind of the challenges and opportunities for investors themselves, and also the landscape in which they operate. So anyone has some questions, do put your hand up. I think there's various. Start back
two
there.
questions, if you don't mind.
Oh, two.
So
wow. Yeah, okay.
first question, when I compare, the investment landscape here in the UK compared to, say, the US, I would say, to some extent, it's slightly more developed. So the question I would ask you is, do y'all, at the time of making a specific investment in a startup, do y'all tend to look at similar startups in the US and what the multiples were, or how the investment was done before you make a decision on investing in that startup? Because at the end of the day, there can only be 5, 6 companies globally in a certain space. Or what's your thought process on that? And then I'll come to my second question afterwards.
Anyone want to make a start?
I can tell you, I look at any comparable and every comparable I can find, but I wouldn't tend to look at the financing journey and compare valuations, because that's, well, it's subject to all kind of vagaries, but I'm looking for what happened at the end. And most of the companies, this may be controversial, which is fine, it's why I sit here, but pretty much every medtech that I might meet, I'm probably having a conversation about when for the US. At some, pretty much from day one. That's just the reality. If they're going to the size of exits that we need to look for the size of our fund, which should be, then it means that they need to have a US plan, because the size of the market is just different. And we beat ourselves up in this country all the time, and I get very fed up with it about we're not as good as the US. We're a fraction of the size of the US. You should compare the UK with a state, not with the country, but we have to. But most of our healthcare is a global thing, and if it's going to make patient impact, it's probably going to do it in a clinic in New England as much as it is in a clinic in Birmingham or a clinic in Paris. And we should. That's how the company should be thinking. So there's a kind of a when and how for the US pretty much across any clinical healthcare company that I might talk to, and if they're not thinking that way and talking that way, then there's probably work to be done.
Tanya, you were just going to add something.
I mean, I would probably say slightly differently, in that we might look at it and we might actually sit there and say, we would advise people in the UK not to try and benchmark against US valuations, because on the whole, certainly in the therapeutic space, US valuations will be considerably higher than UK, and it will be very difficult to meet them. And actually, we're seeing US investors, sort of VC investors in the US, increasingly looking at Europe because the valuations are too high in the US. There's a glut, if you like, of early stage investors in some areas of the US, which has meant the deals are very competitive, which has ratcheted up the price. And whilst there are down rounds or flat rounds over there, it's still wildly different than over here.
Sorry, did you want something, Izzy?
Yeah, well, I mean, I am looking, and I'm looking massively, because for me, my whole theory and thesis around Outsized is the arbitrage at the Series A, or at least to Series B, for a US VC to come in. So I'm not really looking at the valuations or the multiples or anything like that, but I really want to know what makes you different, what's USP that you're going to be able to beat that US even with less money and more efficiency on capital. So, and that's what I'd be looking at, because I'd want to take you to the US for a VC fund to come in. And so we need to have a good story around that. But that's the only reason I'm kind of looking.
Thank you very much for this panel discussion. I'm actually delighted to see that 3 of the panelists are on Innovate UK, because just last week an investor told me that too many grants makes a company uninvestable, and I don't know how much is too much in terms of grant funding. My question is actually related to grant funding and valuation. Would you take the grant funding into consideration when you do the valuations of the company pre-money and post-money?
Okay, another chance, if I may, just to say, valuations are not real numbers. as in, just what? No, I don't mean say that, but I mean, the valuation of a company can't be. There's no way to value an early stage company until it's got so developed that the risk is low enough that you can properly forecast revenues, and then you've got a way to value it. The value up until that point, the valuation is a way that solves an equation about how you carve up the cap table along the journey to that point. And it's not a sort of a real concept, and you have to trying to figure out how to manage it on a journey to an end destination, not measure by it. And that's just...
So valuation is in the eyes of the beholder. It's really everything she said. I'm going to copy. In terms of grants, so you can take, the lady from Booby Biome said something about one of her angel investor on the call saying, your business plan is a work of fiction. You need to put things in context. Okay, so your investor who told you that too many grants make you uninvestable. Not all companies are equal, so it depends on the grants, and it depends on whether there is a progression and whether you're building something using the grants, or if you're going round and round in circle. So the problem with grant funding is that you're solving a question. Is that question critical to that use of funds, to that plan that you've set yourself, or is it a distraction? And so you really need to put this in perspective. I hope it answers your question.
Thanks, great.
I just have something. I mean, I absolutely agree. Grants can be a distraction if they're not on the critical path. So what I would say is you just need to identify what is the milestone and the value creation point that you're trying to achieve, and look at how you achieve that. And that can be a combination of equity and grants. That's fantastic if you can get access to non-dilutive funding to do that. That will be materialised in the valuation at the point upon which you're raising the next financing round, because you've got the value created at that point. I think that what it has to be careful is there a tendency is to go after and land grab all these grants. And the problem is some of those grants are going to require matched funding, so they are taking away some of your equity financing, and they can be distracting, because it's not just the money that you're coming in. You've got to put all that time and effort and management time into operating that grant and achieving something that, if it's not on critical path, will be distracting. And in the current climate, most investors and sort of well-functioned boards, if you're on a tight runway, will not want that distraction.
And we're not all always right.
Yeah, so you've talked about investment proposition, values, down rounds, exit. And I'd wonder, across the panel, what sort of returns you are looking for?
Who's going to
Okay.
start on that?
Well, I might as well
looking for
start because
numbers.
mine's the most crazy. I definitely know it from Rebecca. So we set up very US style, really copying Lux Capital. So, I mean, we come in at pre-seed and seed, and we have got to get validation, or at least we have got to get confident of $1 billion plus an exit. So we've got the most, I think, I know.
Sized.
Yeah, we're the most aggressive in terms of sort of that valuation we need to get to. Hence why we look at literally the 1%, try and identify that 1% founder.
Looking at me now because of the contrast. We believe in unicorns, but we don't chase them, I think is probably one way of putting it. But I think they're called dragons, aren't they, fund returners? So the way we think about it, so our fund is a 75 million fund. We think our job is to turn that into 3x over the time of the fund. That's not competitive otherwise with where the pension funds, wherever they've invested in our funds, could have put their money and made better returns for their savers. That turns out, that translates into something like 10, 11, 12% IRR, something like that. And that's got to be competitive. At the end of the day, it's the LPs that think about IRRs. We tend to think of getting to 3x. And we tend to think of it quite a simple way, that we've got a bucket that we've got to fill with exits from our portfolio. And so, if a company, could return, if I, put £1 million in and got 3 million out and got 3x out, or even 10 million out and got a 10x out of it, it doesn't really do much for the 225 target. So it's about what's the best way to allocate our funds to get exits where, for me, I'm looking at, I want the fund return or at least a half a fund to make a meaningful contribution towards getting to 225. And I still think, we may be chasing heavy odds to get that many good exits. So one thing I would say is that venture capital is still a really young industry, and we're still experimenting with it. None of us, we're all learning, and everybody's raising a different fund thinking they've got a different way of doing it, and there's a lot of debate about how it works. So it's true, isn't it? It's really young, and I start lectures about, talk to accelerator programs and give a lecture and stuff on it. That's where I start, with how young this industry is and how it's changing and how many different business models there are out there and how many different ways of doing it there are out there and how people are still thinking there are better ways to do it. So, it's not rocket science to actually figure out what the investor you're meeting on the other side of the table, what their philosophy is and how they're doing it, and figuring out if you're a fit. Because actually it's not complicated maths. It's not hedge fund algorithms. It's actually really quite simple. So, understand the business model of the people you're meeting and where you might fit in that business model would be my suggestion.
Hanadi, did you want to add anything to that? In terms of your own fund?
So, well, we're very aligned with what you're, in terms of fund return. Maybe let me give you the angel perspective. It's so angels come in earlier than anyone, and you keep their money hostage for as long as you want because there's no secondary, there's no anything. So there's a lot of risk. Honestly, it varies from one angel to the other. I've got a male counterpart where on the same deal, he wants 10x. I'd be super happy with 3 to 5x. So depending on the length of time and your appetite for risk. So basically, it's really important to understand the person in front of you. But normally, angel investors are very patient. They come in super early and know that they're going to have to wait for a very long time. And given that they come in before you have anything, it's normal that they get the 10x, but it takes them a long time and much longer than a lifetime of a fund. Really important for those of you raising money from a vulture capitalist rather than angel investors, look at the lifetime of the fund. Are you coming in at the beginning of the fund, or are you coming in at year 4 or 5, which is the last 2 years where they're deploying capital? Because if you're coming in at year 1 or 2, you've got more time to grow, and before they start sweating you for an exit. If you're coming in at 4 or 5, they'll start sweating you for an exit much earlier. Look at the size of the fund, because the size of the fund will also tell you what kind of exit they're looking at. It's a 50 million or 100 million pound fund. They're not going to be looking for a 1 billion exit. If it's 350 million fund, not having anyone in mind, they will be looking for that 1 billion exit. So do know, just like they do know that they do their KYC, do your own KYC on the fund.
Tanya, obviously slightly different model. What's your...
Yeah, so we're a sort of evergreeny type fund. All the return investment we get back goes back into the fund and back to support research. What I would say is that then that means we don't have a fixed ROI, but we look at every investment opportunity, and look at what our potential credible investors who will invest in the next round will expect. And then we'll look at that in terms of judging whether or not it's whether we can have that impact through our investment. And that's really key, because each of those types of credible investors for that next round will have different criteria. So the other thing to think about is, when you look at corporate VCs, for example, a lot of those are strategic VCs, but their strategy is different. Some of them will be looking at build to buy, some of them will be more traditional VC ROI. So I think for us, it could vary widely depending on whether it's a quick exit, whether it's a long-term investment. For us, we're long-term investors. We don't have to meet a 10-year fund exit, and that means we can take super high-risk investments, and we invest very early. So particularly in the therapeutic space, we know we're going to be in there for a long time, and we can see that. I mean, we've invested or been involved in setting up over 70 companies and had a pretty some nice successes along the way, and a few drugs that or technologies that come out of them that are on the market. But that's taken a long time. And that doesn't always meet every investor profile, but that's something that funds like us, and there are funds, particularly in the US, and there are increasingly these sort of impact funds coming up in Europe. It's worth looking at just in terms of if you are very early, and you can have a good, clear impact story, attached, then it's worth exploring.
Thank you. And obviously, I hope that's been a really important kind of, piece of information or learning point for anyone, that understanding the fund structure and, its duration and its kind of the nature of the fund really does affect the expectation of, what you've got to present in your business and your approach to exit and returns. And we all know, as everyone says, lots of things can go wrong for you, but understanding that from the outset is very important.
Jenny,
yes,
sorry.
I'm just going to say if anyone wants to
Sorry,
carry on.
could I just
Yes.
add? So, really important, two pieces of advice for anyone fundraising. Valuation, we said, is in the eyes of the beholder, but it's also only one term in the term sheet. And honestly, I see so many entrepreneurs obsessed with the valuation that actually they miss all of the other more important terms. So valuation is only one term. It is probably the least important term in the term sheet. So do understand the other terms in the term sheet. That's the first piece of advice I would give you. The second one is, we all look so pretty, so civilized, so lovely. We are going to be taking references on you. Take references on us. Yeah. And do not take references only from our, best swimmers. Ask us for our failures. See how we've dealt with people who've had to go, to go bankrupt, or, just get proper references. It's really important. We're going to be referencing you. It's a two-way street. It's probably easier to get divorced than to get rid of your investor. So do your due diligence, because we'll be doing ours.
Yeah, that's a very important point. Seriously, I mean, obviously you can do a bit today, but that's a generally very important point, and also it means you have the right conversations then as well. Yeah.
You might not always have a choice, but at least you go in knowing who you're doing business with better, and aware of what where you might be heading.
Quite right. So there's another question here.
Yeah, quick one. We obviously are in times of crisis. You started talking about that, and remembering that half of all Fortune 500 companies started in a crisis, and so were Airbnb, Instagram, Uber, and I can continue that list forever. Isn't that the time you should double down and slow it down? So I was wondering what the real reason is for slowing down all the investments, given the fact that if you're in a 6-year investment period and not just raising a fund right now, it doesn't really matter to you if you're in a crisis or not. So the money needs to be deployed anyway. What are you waiting for?
Can I take that?
Please answer that one.
As an entrepreneur, you're lucky, because when you're raising money, the money usually gets into your bank account right away. As a VC, we get a commitment, and we draw down on that commitment. We have seen so many defaults in the last 3 years, so we do not know how much we have. So we have a duty of care to the companies that we've invested in to make sure that we've got enough to actually follow on if there's no other money in the market to help them grow. So we need to balance the opportunity and also the duty of care that we have for the companies already in our portfolio. It's really tough. Trust me. Saying no is something we say all the time, and it's how we say no.
We may also look nice, but we're waiting for the bottom. We're waiting. We want to have those good deals. We want to cherry pick, and we haven't hit the bottom yet.
But the other thing is that you every VC, when it happens, they've got a portfolio of companies they've invested in, unless they've literally raised money at the start, which he's been very fortunate to do. But if you've been investing before the crisis, then you've got a portfolio of companies that are kind of, you perhaps the valuations are a bit exposed on, and you don't know whether they're going to raise the next money, and you've got to balance that whole thing as to which of those companies do you need to invest more in. I mean, we've got a smaller portfolio in this fund than we initially thought we might do, because we'd started investing before the pandemic. And everything, okay, so 2021 went wild, but at the beginning of 2020, everything stopped. And, we got the Future Fund massively helped out. But we did extra rounds in almost all of our companies. So.
Yeah, I was just about to say, so we're not all the same, I'd say. So we sort of take the view that it's an exciting time and nothing drops off. So, I mean, I'll give you COVID as an example, right? You know, there was people shutting down, labs were shutting down. You should sit there and say, well, actually, we had less work to do. We were the busiest we had been ever. And from the seed fund side of things, we're absolutely, it's in our objectives for us to invest, you know, a certain amount per year. You know, we've made sort of roughly 8 commitments so far. Haven't deployed all of it yet, but you know, you're right, it's a super exciting time and the science doesn't stop. I think what we'll just say is that then that's the challenge, is just where's the right investment for us if it's relying on a slightly larger fund than more than we can do ourselves. So we do have to sort of look at how viable it is to raise the rest of the syndicate round. Because, as I said, you know, us putting a bit of money in and moving the dial a bit, if it doesn't unlock wider investment, it doesn't actually achieve the impact that we need it to achieve. But I think part of that's why as well we're supporting, you know, we and a number of other sort of larger institutions are doing a lot in terms of supporting the entrepreneurial programs around the UK, for example, because it's also giving sort of budding entrepreneurs or the first-time entrepreneurs that tool set to be able to cope in quite a challenging environment, because for a lot of first-time entrepreneurs have never faced sort of, even in the good times, never faced the climate of, you know, challenges of heading up or being part of a management team for a startup. And then you couple that with the challenging environment we're in now, and it's difficult. So helping sort of foster that ecosystem that supports people on that journey is quite important in these times, I think.
I'm just going to, we've got just a couple of minutes left, so we're just going to do kind of very quick round here. Is there any key piece of advice you want to give to any of the entrepreneurs in the audience today who might be widely approaching you or thinking of approaching venture capital at this time? Any quick thing you think they should think about? Anyone want to start?
Be enthusiastic. Sorry. Be enthusiastic. I know it sounds strange, but the number of times we have to sort of convey to pitching teams, if you can't be enthusiastic, convey your enthusiasm to me, how on earth am I going to be able to champion that to my investment committee, right? Because they're a group of experienced VCs who want to know that someone behind it thinks this is the best thing since sliced bread, basically. I mean, you can challenge it till the cows come home, but you need a team that quite gung-ho and bullish in this current climate.
I would say the thing I go to accelerator programs to talk about is financing strategy, how financing works. The thing I say to them is to try and understand their journey, so they can understand what kind of financing would suit and what is fits. So, you know, what we're talking about, what's the end game? What might your company look like in 5-10 years? What might the exit be for the investors? Therefore, which investors? What's realistic? And the thing I see most commonly in medtech companies actually is that the maths doesn't really add up. That the opportunity at the end doesn't provide enough of a return to finance the full journey. It's less so with biotech and big, you know, with cancer therapeutics that are kind of like, you know, huge upside if you get there, but other kind of tech, if you really kind of break down what might it look like, it often, that's the challenge. And so being sort of smart about how to finance that is often the challenge. And unfortunately, people kind of need to know that at the start. And a lot of teams sort of push forward and figure out they need to know that when they've already made some decisions on the journey. I think that's...
Did you have last word?
Investors are people. So, and people invest in people. So try and make a human connection. Try and understand that it's not easy to say no as well. Be a Joanna. You know, if somebody says no to you, try to get them to change their mind. And if they want, try to get them to help you.
I think just be brave. I mean, this market, take the risks, keep your cash flow tight, and ask for favours. People will still help.
Thanks so much. So I'd really like to thank you, Izzy, Hanadi, and Tanya. Thank you so much.